both the economy and asset markets are at a crossroads. With respect to the economy, we'll start in the US. We have been in an uninterrupted acceleration in growth since dating back to the second half of 2022. And we're sort of cresting off the top of that growth. And we're now looking down from the top of the hill and trying to assess the speed of decline that we're going to see in growth over the medium term. I think asset markets are having a very open and healthy debate about that. With respect to asset markets, our primary market regime nowcasting tool has indicated that asset markets have been in this, kind of debate between Goldilocks, which is pricing in growth accelerating and inflation decelerating, to deflation, which is pricing in growth and inflation decelerating simultaneously. That debate has been going on for about 6 weeks now in the context of our risk management signaling. But the mere transition from Goldilocks to Goldilocks versus deflation caused our risk management systems about 4 to 6 weeks ago to start taking down risk in equities and to start taking up our exposure to bonds. And obviously, that's been another great call, if I do say so myself.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When I interviewed today's guest last year, he said that the forecast of his proprietary model made him about, quote, as bullish as he'd ever been on stocks heading into Q1. And to give credit where credit's due, his positioning was spot on the money. Both the S&P and the NASDAQ increased by 10% in Q1. And then when I interviewed him again heading into Q2, his model said, stay the course, stay bullish. And again, the S&P rose another 4% in the quarter, and the NASDAQ did even better, rising 8%. So, given this impressive track record, what's his model telling us to expect from here? To find out, we'll ask the man himself. Today, we've got the good fortune of speaking with Darius Dale, founder and CEO of 42 Macro. Darius, thanks so much for joining us today.
Adam, it's a pleasure to be here, man. Thank you again for having me back. That was really a very kind introduction. Thank you.
Well, you're more than welcome. And the intro is nothing but facts. So anyways, I'm sure we got a lot of people very excited to hear what your model's got projected going forward. Before we start, just two things. One, I'm going to ask you the normal kickoff question I always do. But first, I just want to give you an official Thoughtful Money congratulations on becoming a proud father. Just all the well wishes. I know we've sort of been tracking this whole pregnancy since you first announced it. How is being a dad?
Dude, it's the best thing I've ever done. And I know that sounds cliche, but until you go through it, you don't realize how incredible and how awesome of a blessing this is. This man is the coolest thing I've ever encountered, interacted with. It's just such a wonderful joy to spend time with him, man. That's awesome. Thank you.
Well, congratulations on having the son, and congratulations on having a phenomenal wife. As we were talking about before the camera turned on, you look way too rested to be the father of a young newborn.
And one thing I'll say on that, if you guys work at companies that don't offer adequate maternity leave, this is your opportunity to advocate for your wives and other women out there in the world. It's a difficult job being a mom, especially a newborn mom and nursing mom. It's a really, really hard time. So I just make sure that you're using your platform as a male, and certainly in our male-dominated industry at finance, to advocate for our female friends, because it's awesome, man. It's wonderful to see your wife kind of mature into that other role. It's awesome.
God, well, you're such a great man, Darius. Thanks. All right. Well, look, let's roll up the sleeves. Let's dive into it. Here's the kickoff question. What is your current assessment of the global economy and financial markets?
Ooh, it's a fun time, man. So we've been here at 42 Macro dating back to late June of identifying that both the economy and asset markets are at a crossroads. With respect to the economy, we'll start in the US. We have been in an uninterrupted acceleration in growth since dating back to the second half of 2022. And we're sort of cresting off the top of that growth. And we're now looking down from the top of the hill and trying to assess the speed of decline that we're going to see in growth over the medium term. I think asset markets are having a very open and healthy debate about that. With respect to asset markets, our primary market regime nowcasting tool has indicated that asset markets have been in this, kind of debate between Goldilocks, which is pricing in growth accelerating and inflation decelerating, to deflation, which is pricing in growth and inflation decelerating simultaneously. Goldilocks is obviously a risk-on regime in which investors get paid for taking on more risk, both within the context of asset allocation, but also in the context of factor selection within the equity and credit markets. Deflation is a risk-off regime that investors get paid to take on less risk. rein in risk, and ultimately adopt a defensive posture with respect to their portfolio construction in the equity and credit markets. And so that debate has been going on for about 6 weeks now in the context of our risk management signaling. But the mere transition from Goldilocks to Goldilocks versus deflation caused our risk management systems about 4 to 6 weeks ago to start taking down risk in equities and to start taking up our exposure to bonds. And obviously, that's been another great call, if I do say so myself.
All right. Okay. So, in terms of the global economy, the roller coaster car has been moving up, 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 up. It's peaked. Now the question is sort of how steep is the pathway down. From an investing standpoint, we're going from very risk on to something else. Still maybe debatable. And again, we're going to get into all your charts and all your data. But it's debatable enough that you said 4 to 6 weeks ago, you started de-risking on equities, started getting more into bonds, and that decision has already paid dividends for you.
Oh yeah, absolutely, absolutely. If I can just show you a quick chart in terms of how this process works for us. So I'll take a step back and just help investors explain how it is that we go about approaching financial market risk, because we do things quite a bit differently than the average investor here at 42 Macro, and we're quite proud of that because we've had obviously superior results since the inception of our firm, or 3.5 years ago. And
Darius,
so
let me just interject real quick before you get going here. I want to underscore what you just said. You take such an unbelievably structured and data-driven approach. It's such a joy, and folks, don't have to take my word for it. You're gonna see Darius prove that here in just a second. But one of the other things that you do really well, Darius, is you take all this data, all the structure that we're about to talk through here, and you boil it down into something very simple and actionable. And I'm presuming at some point we're going to get to your KISS model, your keep it simple, stupid model. And I want to commend you before we get through here, because if anybody's feeling a little lost in the data we're about to go through, it's going to get very understandable and very distilled when Darius gets to the end.
Yeah, absolutely. I was going to say that part for the end. Our KISS portfolio construction process, which is the systematic asset allocation approach that we use to help retail investors stay on the right side of market risk. And then we'll unpack our discretionary risk management overlay, which we use to help sophisticated retail traders and obviously institutional investors stay on the right side of market risk. They both use a lot of the same tools that we built, but one is a little bit more simple to execute relative to the other. So, but we will say that for the end, because I'm sure you got a lot of great questions to get through before we get into that.
And you get a lot of great data.
Yeah, exactly. Answering this question about the sort of debate we're seeing emerge in asset markets between Goldilocks and deflation, which I think is a really relatively healthy debate from a fundamental standpoint, and we'll talk about that later in the presentation. But just, it helps to help the client or the viewer to understand, what it is that we're trying to do when we're talking about the market regime, and how does that apply to our investing frameworks, and what recommendations we're telling our clients to put on in their portfolio. So in terms of what we do here for our clients at 42 Macro, the number one thing we do is help them identify and position for the market regime. And the market regime, as you can see here, there are 4 specific market regimes. Goldilocks is a risk-on regime with a disinflationary bias. Reflation is a risk-on market regime with an inflationary bias. The 2 risk-off market regimes are inflation and deflation. Inflation is a risk-off market regime with an inflationary bias, and then obviously deflation is a risk-off market regime with a disinflationary bias. And so we use our global macro risk matrix, which is a market regime nowcasting tool that we built to help investors identify when those market regimes, kind of pivot from one regime to the next, so that we can help them reorient their portfolio in terms of the factor leadership that they should be expecting across the various factors and sectors and assets within their portfolio. And then the second thing we do is help them position for a regime, or help them proactively prepare for regime change using either quantitative signals, vis-a-vis our grid model, our macro weather model, our positioning model, or our global liquidity monitor. And then we also help them prepare for regime change using qualitative signals. Where's growth headed? Where's inflation headed? How's policy going to respond to that? Where are we in the liquidity cycle? Things of that nature as well. So it's a very robust and comprehensive process. But there's one thing final thing I'll say on this is, as if you're watching this, and this might seem quite a bit complicated, but just keep your eyes obviously at the top here, because what we try to do for our clients is help them understand that the best investors in the world, the institutional investors that we speak to on a regular basis here at 42 Macro, they separate their research from their risk management. Their fundamental research views. What do they want to like? What do they like? What do they dislike from their risk management, which is when do I buy and sell what I like and dislike, and how much do I buy and sell when I buy and sell it in terms of the things that they dislike. And these things help us understand what we are likely to like and dislike, but ultimately the actual taking up of the positions, the grossing out of positions, those kinds of decisions, those are more left to our quantitative risk management signaling, which, as we spoke about earlier, are being driven by our KISS portfolio construction process, and our discretionary risk management overlay are being driven by that. So, just finally, thing I'll wrap up in terms of helping investors kind of understand the model that we use to help them nowcast the market regime for them. It's our global macro risk matrix. And what this model does is it scores each of these 42 markets. These are 42 of the most important markets across equities, volatility, commodities, currencies, and global fixed income. And we're scoring them through the lens of our volatility adjusted momentum signal. And then we score each of the regimes based on the relationship between the current volatility adjusted momentum signal relative to how the asset has historically performed. And so we tally that up on a daily basis and to understand which regime is effectively being shown the most love by the collection of volatility adjusted momentum signals in the table. Right now, it's deflation. As you can see here, for the past kind of 4 or 5 weeks, we've had a real healthy debate between Goldilocks and deflation. And so in terms of market regime, in terms of how we've communicated that to clients, we've said, okay, from an asset allocation perspective, you can stay in Goldilocks, but from a portfolio construction perspective, you should be pivoting towards deflation because that's more in line with where the economy is headed in terms of defensive leadership within the factors in the equity and fixed income market. And that's obviously what's played out since we've made that pivot in late June.
Great. All right. So a couple questions here. So there's these 4 key themes, which I think is super important for the viewers to realize. You're always going to be in one of these 4 themes. And Darius, I know you played football at a much higher level than I did. I only made it through high school football. But this is kind of like knowing which you're coming on the field to play, right? Are we playing offense? Are we playing defense? Are we doing special teams, right? You got to know what to expect when you get out in the field. That's what this model helps tell us.
100%.
And I'm not sure if I've asked you this in the past, but the indicators that you have here, right? Are these leading or are they concurrent? Is it saying like we're in deflation now, or as deflation wins out, is it suggesting that what's coming up is going to be more deflation?
Yeah, so this is concurrent. This is our now casting of what's actually happening in market terms through the lens of our volatility adjusted momentum signal. So, for example, we'll just pick on one of these assets here. For example, the 10-year Treasury yield has been bearish VAMs really since going back to the second week of July. And so what that essentially means is that we've had negative price momentum, and the volatility of that asset is confirming that negative price momentum since the early part of July. And so we're doing that same process again across all these factors in the table to identify which regime is essentially is the most dominant at any given time. And what we found is that going back to the back testing, there's really only about 3 times per year where these phase transitions really matter. Because what we're trying to do essentially is help investors identify when the new regime starts so that they can change their positioning on time to benefit from the subsequent performance in markets. And what we found that over a 1-year, trailing 3-year, trailing 5, 10, and 20-year time horizon perspective, when you look at those look-back periods, there's really only been about 2.5 to 3 material transitions per year, i.e. going from a risk-on regime to a risk-off regime. So that's going from a bull market to a correction back to a bull market, or you're in a bear market, then you have a sharp recovery, some positive news, and you go back to the bear market. That's essentially the kind of process that you typically have in any given year on an annual basis. Obviously, not every year is the same, but generally speaking, that's pretty much it. And so it's our job. We built this system to help investors understand, okay, we are now going from regime A to regime B, and you need to make all these changes in your portfolio, or you need to make some of these changes in your portfolio to remain on the right side of market risk. Because again, it's not our job to tell the market what it needs to do. It's our job to make money. And our job to make, and making money means you're long the things that are going up in price, and you're short or down or not in the things that are going down in price. And that's the number one thing we help our clients do. And that's why our clients generally stay on the right side of market risk.
Okay, and that's actually really important, where it sounds like there's only 2 to 3 regime changes usually in a given year. So this isn't something that's swinging back and forth, and people are like, "Well, if I miss this one, I'll catch the next one." This is okay. You only, let's use the football analogy, right? It's not quarters. You got three halves or whatever you want to call them in the year. Make sure when you're getting on the field to play for the next couple months, you're playing the right game.
Exactly. I mean, and again, there's nothing scientific about the duration of the regimes. It's really a function of what's being priced in from an economic standpoint, and also and relating that back to where we are in the positioning and liquidity cycles. But if you think about this just from a risk management standpoint, we bounced into a risk-on regime going back into the mid-November of last year, and we remained in a risk-on regime all the way through to sometime in July, essentially. We started kind of forecasting this eventual pivot towards deflation going back again to late June. But generally speaking, we haven't had actually a risk off regime become the dominant regime since kind of October to early November of last year. So these regimes can be long and persistent depending on, again, what's happening with the main macro cycles that matter, which obviously growth, inflation, policy, corporate profits, liquidity, and positioning.
Okay, so maybe the main question for this whole video, I said in the intro when I talked to you back in, I think it was October of 2023, maybe November. Actually, it was probably a little bit closer to December, I guess, if I remember. Coming into Q1, you said, hey, looking at my model, I'm about the most bullish I've ever been. And it's because we were in that risk-on regime. Now it looks like we're entering a risk-off regime. Are you no longer so bullish?
Yeah, absolutely. We're cautiously optimistic. I know that I hate that phrase because at the end of the day, it doesn't signal much. But I do think in the context of a systematic process, cautiously optimistic does have actual merit in terms of what it's actually communicating to clients. The reason we're cautiously optimistic, there's a few reasons why we're cautiously optimistic, but primarily it's our take on growth with respect to where we are headed from the perspective of the U.S. economy. So there's two big statements I'll make that are probably divergent relative to what a lot of investors are hearing on podcasts like these or are looking at on Twitter, which is we do not think there's a high risk of a U.S. recession over the medium term. And how we define the medium term in our risk management nomenclature is we think in 3 to 12 months. Anything beyond 12 months we consider to be long term from the perspective of risk management. So with respect to how the current compendium of persistent leading indicators that we've identified, which we can unpack shortly, those indicators are suggesting that there is limited risk of a recession in the U.S. economy over the medium term. So that's statement number one. That's going to sound a little bit different than what most people are hearing. Statement number two, that should sound a little bit more different than most people are hearing, is that even though we expect growth to slow, we don't have growth slowing as fast as consensus expects growth to slow over the medium term. So therefore, you could have a sequence of positive economic surprises developing, as we, kind of move forward in time over the next few quarters. And in our opinion, that could potentially create some positive absolute returns in equities and credit type asset classes. So here is our grid model. What this model is designed to do is try to forecast the rate of change of growth and inflation, and then use those forecasts to create a high probability sequence for the bottom-up grid regime. And so we talked about the top-down, the market regime earlier, which is the 4 different market regimes and how we help the clients anticipate and position for those. The bottom-up grid regime is what the market regime is generally trying to price in. Now, it's not always pricing in, today is, we're in deflation, or tomorrow we're in inflation, and therefore today the market regime has to be in deflation or inflation. But generally speaking, the market regime and the bottom-up macro regime, what the economy is doing, are somewhat pretty tethered. And so just thinking about the next 12-month outlook, you're kind of looking backwards, actually, start looking backwards. We've been largely, since early 2023, the modal macro regime on a monthly basis has been Goldilocks from the perspective of the U.S. economy. That means growth has been accelerating, check, and inflation's been decelerating. If you look at it over the past kind of 3 to 6 months, we've had a little bit of a slowdown in growth, not much of a slowdown, but a little bit of slowdown in growth. We're kind of cresting off the top, as you can see here, and we kind of started to bounce sideways from the perspective of inflation. When you look forward in time relative to our estimates and our estimates relative to Bloomberg consensus, you look forward in time, we are starting to see deflation emerge as the highest probability regime for the third quarter. Deflation, again, is growth slowing and inflation slowing simultaneously. And then we're seeing inflation start to emerge, particularly once you get into the first half of next year. I mean, inflation is accelerating and growth is going to continue to slow. And so, in our opinion, we do believe these inflation eyes will cause some problems once we start to see a gap emerge in the reported data in our estimates relative to Bloomberg consensus. But I don't think we're anywhere near there yet in terms of markets having to think about that and price it in. I think we're still in the phase of trying to debate how fast is growth slowing, and if growth is slowing not as fast as consensus is expecting it to, then we could actually see some positive absolute returns in markets, or albeit with a defensive leadership framework.
Okay, and maybe you just answered my question there, but if we're entering a deflationary regime, I would generally think folks would want to do what sounds like you've started doing, which is reduce equity exposure, go longer on fixed income, because you're concerned. I would think you would be concerned about equities in a deflationary regime. But what I think I hear you saying is maybe yes on a high level, but because there may be some of these upside surprises, like things didn't slow as fast as current expectations suggest they are, in the more conservative defensive equities, there may still be some upside potential. Did I get it right?
Absolutely, 100%. Absolutely. And we've seen plenty of history, back-tested history in terms of the U.S. Equity market showing that outcome. So you go back and you kind of just look at a factor like mega cap growth. Mega cap growth, we've had 14% of the cumulative performance in mega cap growth. That particular factor has come, 14% of the cumulative performance has come when we were in a deflation market regime. So that tells you that, historically speaking, we have had periods of time where either growth was surprising to the upside or inflation was surprising enough to the downside in a bottom-up deflation regime, whereby it was allowing the Fed to implement dovish policy, or the growth outlook was obviously being revised up, even though the trend was the delta was negative. And so we have plenty of factors historically that have had positive absolute returns, and a significant portion of their cumulative performance occur in a deflation market regime. And so we've identified those factors as factors for our clients to have positioned, kind of long and out of the factors that typically do not perform well in deflation. So the types of factors that we would like in this scenario are obviously mega cap growth, quality, large caps, dividend compounders. You think about the types of sectors you would like: consumer staples, healthcare, and utilities. Those are the types of sectors you like, and information technology as well. And so if this market is a buy the dip market, and we ultimately resolve this correction with higher prices over the medium term, in our opinion, those are the kinds of factors that are likely to lead, based on our relatively sanguine economic outlook, that says growth is going to slow, check, but it's probably not going to slow as fast as consensus. Inflation is likely to slow, and ultimately, we do think those types of dynamics are supportive of the policy outlook as well. So, in our opinion, we do believe there's some cautious optimism there from the perspective of our, bottom-up macro regime forecasting process, and as well as our business cycle analysis. And I think you're probably going to have your next question is, what about recession, my friend? I assume.
That's coming. That's not the next one. But real quick, because you said your recommendation has been to de-risk a bit on the equity side.
Yep.
By de-risking, I assume that means selling down the positions that are not in the list that you just talked about, right? So you're basically you're still holding on to the sectors that you think are going to do well in this type of, or could do well in this kind of deflationary regime.
Yeah, absolutely. So while we're on this subject, I think it does behoove us to talk about the two processes we use to help clients stay on the right side of market risk. So we'll talk about the movement, the defensive, the changes that we made in our KISS portfolio construction process, starting back in early June when we started increasing our allocations to fixed income, and late June when we started decreasing our allocation to equities. And then we'll talk about how in late June as well, throughout the month of July, we were getting increasingly negative signals from the perspective of the factor leadership that we're talking about, i.e. which sectors, which factors within the equity and credit markets. So I'll start with our systematic KISS portfolio construction process. This is the process we use to primarily help retail investors with their broad asset allocation and to keep them on the right side of market risk. And, I don't want to beat a dead horse here. Folks can definitely check out our previous interviews on this subject. But, there's sort of three main elements of KISS that contribute to very positive performance, certainly relative to our benchmark, which is 60-40. So the number one, with respect to the number one element, is the factor selection process. We've infused Bitcoin into this 60-30-10 trend following strategy as an alternative vehicle in the context of our kind of longer term bearish views on bonds, which I have a lot of fun charts to show on that later in the presentation. The number two element that's helpful for clients is we use that, going back to that global macro risk matrix, that market regime nowcasting process that we talked about. We use that market regime nowcasting process to infuse volatility targeting into the strategy to help investors, to help guide the overall target allocations to the various asset classes. And then lastly, we use our volatility adjusted momentum signal to incorporate dynamic position sizing into that 60-30-10 trend following strategy. And so, the reason we use those two elements in terms of our top-down risk management overlay and our bottom-up risk management overlay is because they allow KISS to produce far superior results than they otherwise would if you were just naked long 60-30-10 stocks, bonds, and Bitcoin all the time. And so you can sort of see this in this back test where we show KISS has an average annual return of plus 15% on an out-of-sample basis since January of 2018. That plus 15% compares to plus 8% for the 60-40 portfolio, plus 14% for if you're running 60-30-10 SPY, Ag, and Bitcoin, which are the three vehicles we use in the program. If you were just running that naked without any of those overlays, then you would have a 14% average annual return. But where you would suffer is on the risk side of things. So KISS featuring those overlays as a max drawdown of minus 12%, and it's the only double-digit drawdown in the entirety of this out-of-sample backtest. Whereas 60-40 has a max drawdown of minus 22%, and that's occurred twice over the life of this kind of 6-7 year backtest. And then lastly, KISS 60-30-10 SPY, Ag, and Bitcoin raw without those overlays has a max drawdown of minus 26%, which is more than double the max drawdown of KISS. And oh, by the way, you've crashed minus 3 times in this particular out-of-sample backtest. So KISS really earns its it earns its stripes in terms of its Sharpe ratio and its Kalmar ratio, which is just the average annual return divided by the max drawdown statistic, is blowing 60-40 and 60-30-10 raw out of the water. And so, finally, answer your question, Adam. Johnny, just want to make sure investors understood where we were before we get here. All right, so just looking at the actual current KISS portfolio construction, kind of landing this plane for you, we are currently at 35% cash, which we use the USFR ETF, those are floating rate treasuries, to manage the liquidity in this. Obviously, clients can use whatever liquidity vehicle they most prefer. We're at 50% of our max exposure of 60% in equities currently. And we took down that equity position in half dating back to late June when our market regime nowcasting process started to signal, when our volatility adjusted momentum signal for the stock market started to signal that it went from bullish to neutral. And so that was a downgrade from the perspective of its own momentum, which caused the model to cut the position in half from the perspective of our bottom-up risk management overlay. We're at 100% of our max exposure of 30% in the fixed income asset class vis-a-vis the Ag ETF. And we went up, prior to early June, I think we had, kind of less than a quarter of the total in terms of allocated to fixed income. And we started to see that aggressively increase once we got into early June in terms of the breakout that we saw in bonds and the breakdown that we started to see in interest rates. And so the systems took our allocations up to fixed income as a function of that. And then lastly, we're at 50% of our max exposure of 10% in Bitcoin. So we had a phenomenal trade on Bitcoin, the system, in terms of taking down client exposure on Friday. Obviously, we had a significant drawdown over the weekend that bled into Monday. And then yesterday, we actually increased our exposure back into Bitcoin. This system is not designed to be a trading system. On average, there's about 4 trades per month throughout the duration of this out-of-sample backtest. So it's not a very active system, but it has been more active than normal in recent months because markets are, again, as we talked about at the beginning of the presentation, they're at a phase transition. So you're starting to see changes in signal from the perspective of our volatility, just a momentum signal for some of the key macro exposures in the market. Specifically, if you look at the stock market, our model, this is perfect evidence of the model going to neutral, before the actual drawdown occurs, which typically happens. As you can see here, our models almost always click on to neutral before the drawdown occurs. So they also do a great job of helping you get back invested pretty quickly after the drawdown as well. They're specifically optimized to help clients get back in after a crash or a significant correction. So this system is definitely working in terms of helping our clients stay on the right side of market risk and generate superior results, certainly relative to 60-40, but relative to a lot of what I hear out there, which is obviously bear porn, because obviously bear porn gets people like myself paid, but it doesn't necessarily get the client paid.
Okay, so just fantastic. And folks, this is what I was talking about earlier about how, all the data, all the structure that Darius, walks us through and that he and his team do with their firm. They do an amazing job. Actually, keep that back up if you can.
Oh, sorry, my bad.
Of making it really easy from an actionable standpoint, where they basically create this 4-input portfolio that helps you ride, it helps you put their framework into practice, all their data into practice. And I won't make you go back to the previous chart, Darius, but you showed us how relative to the standard 60/40 portfolio, or just buying each of these four components yourself and just sitting with them long, you using the KISS portfolio, Darius's portfolfolio, you appear to get the best returns with the greatest ability to sleep at night. And who doesn't want that, right?
That's why we exist. That's
yeah,
exactly why finance exists.
Go back to your other chart there for a second. So first off, I just want to say, look, I know it's not a trading vehicle, but I'm super impressed by what you just said about how the model told you to sell Bitcoin and sell Bitcoin totally. Did you go to zero on the Bitcoin allocation?
Yep, went to zero. So in terms of how that process worked, so the just real quickly, the target allocation for Bitcoin is 10% because we are in this Goldilocks with deflation hybrid market regime. So we're anchoring on Goldilocks from an asset allocation standpoint, deflation from a factor leadership standpoint. And then we went to 0% in Bitcoin because Bitcoin broke down to bearish from the perspective of its volatility, just a momentum signal going back to Friday. It broke back out to neutral yesterday, so we bought it. It went to 50% of the target allocation yesterday, which equates to a 5% overall position in the portfolio. And obviously, Bitcoin's having a big update today, so we kind of got lucky. It's better to be lucky than good sometimes, right? I mean, the models are actually working in terms of identifying prospective market risk ex ante to get our clients to the right side, so they can sidestep something like a dramatic drawdown that we saw in the crypto asset class over the weekend, and getting us back in just in time for the big recovery. And that's exactly what those systems, this bottom-up risk management overlay and this top-down risk management overlay, are designed to do, is to help you get out near the top and get back in near the bottom. And that's how it compounds returns with much better risk and reward ratios and metrics than the 60/40 portfolio, or just running a system like this without the overlays that we built into it.
All right. Well, yeah, and just for the folks that don't track perhaps Bitcoin very closely, at the end, near the end of last week, let's put it this way, Bitcoin was in the mid to high 60s. It then over the weekend plunged as low as 49,000 a coin, then recovered a little bit, and I think since you guys bought back in, it's now pushing 60,000 again. So massive dip, massive recovery again. Maybe it's just more lucky than normal this time, but extremely well played, at least on that movement. So want to give the model credit. So let me ask you this. So I'm going to jump to kind of the end here, and then we're going to go back through some questions. I know you got some more great data to walk us through, especially around bonds. People can follow this, right? They can subscribe to 42 Macro, and they can basically be told in real time what your portfolio is saying to do, so they can make those changes in their own portfolio if they want to. So basically, if folks want to if they want to practice KISS, they can, correct?
Absolutely. It's like I said, it's very simple to execute. There's only ever 4 ETFs in the program, and there's on average about 4 trades per month in terms of the executing the program. So it's about as simple as it gets. But I mean, in my opinion, I think simple is the way to go. Keep it simple and keep it systematic. You don't need to complicate investing. And particularly when I'm talking to our retail investor friends, because we do something a little bit different for our institutional investor friends or our sophisticated retail trader clients. But the reality is, if you're a retail investor, you have one job and one job only, and that's to retire on time and comfortably. And most of the time, the decisions that investors make in their portfolios generally speaking, tend to push them away from retiring on time and comfortably. And so one of the things that we do, and it's really core to our research here at 42 Macro, is helping investors understand the common behavior heuristics that prevent them from retiring on time and comfortably, like succumbing to the action bias, over trading, succumbing to the availability heuristic, constantly anchoring on what just happened in terms of their expectations about the future. Things like recency bias, the illusion of validity, assuming that you have the greater ability to forecast the future better than others, or even the hindsight bias, thinking that investing is easy, going back and looking at the chart. Well, everyone could have sold here or bought here. That's never how it works. There's always risk involved when you're talking about investing. And so one of the things that we do here at 42 Macro is we build specific quantitatively oriented solutions into our research process that are specifically designed to help investors overcome those biases. And by the way, they help me overcome my biases because Darius Dale is human too.
All right. And, I talk a lot in this program about the importance of understanding behavioral economics. I love the fact that you have them built into your process here to try to protect us from our worst selves.
We are our own worst enemies, Adam, when it comes to investing.
Absolutely. So, look, I mean, it almost doesn't get simpler than, hey, here are four vehicles to just,
Toggle up and toggle down. That's literally it.
yeah, and you're
Toggling up
telling
my
them,
equity exposure, I'm toggling it down. I'm toggling up my bond exposure, I'm toggling it down. I'm toggling up my Bitcoin exposure, I'm toggling it down. That's literally all that happens in this KISS process. If you do
great.
KISS for the next 20, 30 years, you're going to retire on time and comfortably, if not sooner.
Okay, so and the gardening sounds pretty easy. In other words, it says, it sounds like on average, it's only like 4 changes a month or more to the model. Where I'm going with this is, so my mind goes to, gosh, if this works so well and it's pretty straightforward, would you guys at 42 Macro ever create an ETF so that I don't even have to do the gardening myself? I literally can just buy the ETF and just let it ride, knowing that you guys are doing the tinkering.
That's coming down the pike. We're actually kicking the tires on that with either ETF structure or an actual fund structure. I'm doing my own due diligence on that, meeting with different funds and different investors to kind of see what the best path we can take. Because obviously we're a legacy research business, so we don't want to be too AC in terms of developing that. But eventually, yes, that will be something we offer to our clients.
Okay, fantastic. Well, Darius, I mean, you always have an open invitation to come on this channel, but if and when you make the decision to do that or a different solution, please come on the channel, tell us all about it. Folks, if you'd be interested in obviously sort of a special session with Darius, if indeed he ends up putting all this into practice into a simple trading vehicle, let us know in the comment section below. Although Darius, I feel like I'm just stating the obvious. I'm sure almost everybody watching is going to be interested in that.
Gotcha. And before we move on, because I feel like we've been giving a big bear hug, a big Darius Dale bear hug to all of our retail investor friends. What most of our research is primarily focused on helping professional investors stay on the right side of market risk. We obviously distill that stuff down into these clear, actionable signals from the perspective of our KISS portfolio construction process. But the reality is, I cut my teeth on the global institutional landscape in terms of servicing investors across global Wall Street. And what we're trying to do here at 42 Macro is make sure that we help those investors stay on the right side of market risk as well. And how we do that, the simple tool that we built to help them to communicate all of our research findings in terms of a clear, concise, actionable method is our discretionary risk management overlay, or Dr. Mo for short. And what this model is designed to do is help investors. Dr. Mo prescribes proper trade recommendations for every major factor in the world at any given time based on the interplay between the market regime and the volatility adjusted momentum signal for that particular asset. So, for example, in this Goldilocks with deflation characteristics, a hybrid market regime, the assets that should be bullish and are bullish in that regime get a long max position proper trade recommendation. So not only is it helping you with market timing, it's helping you with position sizing as well. The assets that are neutral but should be bullish in this particular regime get a long half position recommendation at the current juncture. The assets that are neutral but should be bearish in this particular regime get a short half position proper trade recommendation, and then the assets that are the assets that are bearish and should be bearish get a short max position, and then assets that are bearish and should be bullish, or bullish and should be bearish, get a no trade. So don't do anything in that particular exposure because the market regime and the independent volatility adjusted momentum signal for that particular asset are just confirming each other. And so what this table allows investors to do is really quickly identify, okay, what is the market regime based on the current momentum, the volatility adjusted momentum of the asset? How should I be positioned and how much should I be positioned in these particular factors? And just check back with the table on a daily basis. And if it doesn't change, you don't change. From mid-November all the way until late June, the S&P 500 was in a long max position condition because the volatile adjusted momentum signal was bullish and the market regime was bullish. Well, both of those conditions have changed. The volatile adjusted momentum signal for the SPY has gone to neutral, dating back to late June. And obviously, we moved into this hybrid market regime coming out of the persistent Goldilocks and reflation market regimes that we saw throughout the first half of this year. So when the things change, we get loud about the change. We highlight the changes in colors. These are the things that change today in terms of the signal. And then obviously we communicate to our clients why those things are likely changing, what we expect, how we expect those signals to evolve. But ultimately, at the end of the day, we don't really care about the future. What we care about is the now and the inflection, so that those clients can take that inflection and actually implement the changes in their portfolio to make sure that they are giving themselves the best chance to stay on the right side of market risk.
Awesome. All right. Well, look, when we wrap up this interview, which is coming up faster than I wanted to, but I'll give you a chance to tell everybody, both regular retail and professional investors, where to go to take advantage of the awesome resources that you guys offer at 42 Macro. If we can, let's zip back to the chart where you were looking out ahead, saying, okay, we think the next quarter or so is going to be deflation, and then we think we may flip to an inflationary regime.
Yep,
Do you
correct.
remember the chart I was talking about? That one right there. Yeah. So let me ask you this. What is driving your forecast that we're going to switch from the D to the I?
Yeah, absolutely. So we built a model that tracks and forecasts inflation and growth. These are both autoregressive tools that tell us where we're likely to be on a future state in the time series based on the lagged variables of the time series. And historically, in that model, in terms of its forecast error, so it has a 73% accuracy rate in terms of projecting the delta on growth, the sign of the delta on growth. So if we project an acceleration, the growth or inflate growth actually accelerates 73% of the time, and vice versa. If we project a deceleration, growth decelerates 73% of the time. The directional accuracy for Bloomberg consensus, for instance, is only 65%. So that's all the Wall Street economist consensus that take the median of those estimates for growth and inflation. And our model is a little bit better in terms of projecting the direction of growth and inflation, or direction of growth. And it's a little bit better in terms of projecting the direction of inflation as well. That's a 71% directional accuracy score relative to Bloomberg consensus, 65%. And so what this model is, again, is trying to do, I'm less concerned about the actual specific levels. I mean, obviously, we pride ourselves in getting and having accurate forecasts. But what really matters to me in terms of interpreting this type of analysis is, what's the general trend in growth? Is it up or is it down? Is it just a general trend in inflation? Is it up or is it down? And then how is that general trend relative to consensus? Are there material divergences in consensus? As I mentioned, in growth, we're likely to be higher than consensus on growth over the medium term. And specifically, once you get in the first half of next year, we're likely to be divergent both in direction and in terms of magnitude on inflation. And so those are the types of things that we'll flag for our clients, because those are the types of scenarios that will occur in the economy that have a high degree of creating, contributing to an evolution of the market regime.
Okay. So two questions here. I'll try to wrap into one, which is, even though you're higher than you expect to be higher than consensus on growth going forward, it's still declining growth.
Yep.
And you do see your model sees inflation creeping back up. I think a lot of people would define that as stagflation,
Correct.
right? Versus pure inflation. Sounds like that's what you expect to see.
Yep.
But again, to my earlier question, and maybe your model doesn't tell you this, and maybe it does, but what is driving the increase in expected inflation? Is it I don't know, you expect wages to go up? Is it you expect there to be supply chain issues? I don't know. Like, what is the model saying, displaying that suggests that inflation should be creeping back up?
So statistically, from a time series perspective, we're just going to hit the bottom of the cycle and we start reaccelerating. And that's very likely to occur if we don't have a recession. And again, as I mentioned, and we can talk about this secondarily.
Which is my next question after this. So yeah.
Exactly. So if we don't go into recession, it's highly likely that the time series just continues to cycle like it always does from an inflation and growth standpoint. It's very unlikely that we we cycle up in inflation, cycle down in inflation, and just go sideways, because there's no history in these time series for them to do that. And so this is why autoregressive modeling practices are the gold standard across global Wall Street. And so, we kind of continue to hang our hat on that, because as you can see in the back test, they produce superior results even relative to Bloomberg consensus. So this is a very important chart here that shows that kind of helps, kind of answer the question, okay, where's the reacceleration in inflation going to come from? And this is the fact that inflation is the lagged inputs on inflation. The base effects are getting easier in that particular time horizon over the, kind of once you get into the first half of next year. So this chart on the left shows the median trailing 10-year delta adjusted Z-score for each of these cycles of the economy in months before and after recession began, with zero being the beginning of a recession. And what each of these plots shows is how each of these time series or cycles within the economy have evolved since in the post-war U.S. economy. So what we did is we did a big deep dive study that sort of stacks each of these time series on top of each other to identify, okay, how has how have each of these processes or procedures in the economy evolved kind of in and around recession. We've also done that in and around recovery as well, but that seems to be less relevant at this particular juncture. And then we've also used this analysis to identify which indicators are leading indicators, which indicators are persistent leading indicators, meaning that they lead in the downturn and they lead in the upturn because they're not all persistent leading indicators. And when we go back to that previous chart, to answer your question on inflation, what we know is that inflation is the most lagging indicator of the business cycle, Adam. Mm-hmm. So in terms of how the business cycle works, when you're talking about heading into a downturn or a slowdown in growth, how that typically works is that policy first breaks down. So these are all delta adjusted. So obviously policy rate going higher, policy rate going down on a delta adjusted basis just to align it with the direction of the business cycle. So typically you have policy tighten first, then you have the corporate profits breakdown, then you have liquidity breakdown shortly after corporate profits. Then let's call it 1 to 2 quarters later, you have growth breakdown. Then stocks kind of break down right alongside growth. Then you have a couple of quarters later, employment breakdown. Maybe a little bit after that, credit starts to break down. And then finally, 12 to 15 months after recession starts, inflation breaks down below trend. And so this is one of the most aha moments that I've ever had in my career. We've talked about this on your program previously, Adam, in the sense that, historically speaking, it's very unlikely that we're going to have inflation return durably to trend absent a recession in the U.S. economy. This chart shows the same analysis. It's just a little bit less cluttered. You see growth breaking down, and then you see headline and core inflation again breaking down 12 to 15 months after a recession has started. And so if this is how all the post-war business cycles have contributed to this particular analysis, and this is the typical path of these various cycles within the economy, how they evolve, heading into a slowdown in growth and a potential downturn in the overall business cycle. And so the key takeaway is, Adam, if we don't go into recession, then inflation is just going to do what it always does, which is hit the bottom of the cycle and start accelerating higher.
Okay, makes total sense. So you said early on in this interview, you guys at 42 Macro don't see a high risk of recession in the next 3 to 12 months.
Right.
And let me give you the floor to explain why.
Yeah,
because you're right. We have seen an increasing number of people, in the media, but also certainly coming on this channel saying, recession looks unavoidable. And some even saying, hey, I think we're already in recession right now. So what's it giving you confidence that we're not quite there yet?
Yeah, 100%, man. That's a great question. So we agree with the general consensus determination that the economy is late cycle. We obviously have a very low level of the unemployment rate at 4.3%. We obviously been inverted in the yield curve every month since going back to the initial inversion back in October of 2022. So we agree the economy is late cycle, but late cycle can last for much longer than a short, a bear porn purveyor can remain solvent in short positions. So just be aware of that. So in terms of identifying assessing the risk of a recession over the medium-term time horizon, we're using the same deep dive empirical study of the business cycle, and we have aligned. So we're also tracking and now casting each of these indicators on a current basis to identify are they arrayed, or are they aligned in a way that is historically consistent with how they typically have progressed leading into a recession? And the answer is by and large no. And so this chart again, we just talked about this chart where we show all the main cycles within the economy and how they have historically performed, kind of leading into a recession. And then when the chart on the right just shows how they are performing now. And as you can see, we have policy significantly tight right now, but we don't have the breakdown in the corporate profit cycle that you typically see. Let's call it, the 3 to 4 quarters ahead of a recession. We don't have a breakdown in the liquidity cycle that you typically see about 3 quarters ahead of a recession. You don't have the breakdown in the growth cycle that you typically see about 2 quarters ahead of a recession. And obviously the stock market cycle has not broken down, which is what you typically see about a quarter leading up to recession. So right now, eventually, we're going to use the same analysis to say, okay, there is a high probability of a recession over a medium-term time horizon, which is 3 to 12 months from our perspective. But right now, the current constellation of these leading indicators is suggestive that there is limited risk of a recession over the medium term. We can sort of see this when we drill down into the various cycles themselves. This chart shows, again, the median trailing 10-year delta adjusted Z-score in months before and after a recession begins. And so to how the corporate profit cycle works, the corporate profit cycle first, corporate profits themselves, NIPA corporate profits break down first. Then our corporate profitability model, which we use to now cast corporate margins in real time, before we get the NIPA data, that tends to break down let's say it's about 2 quarters ahead of a recession. Corporate profits themselves break down about 3 to 4 quarters ahead of a recession, and then growth breaks down. So if you just kind of isolate the variables that lead growth, and specifically our corporate profits, NIPA corporate profits, and our 42 macro corporate profitability model, that is those dynamics are not very much not looking like you would typically expect them to see. Let's call it, with the recession kind of lingering on a medium-term time horizon. And then finally, when you look at some of the indicators within the labor market, when you kind of think about sequencing the labor market, the things that lead growth are stuff like non-farm productivity and private sector hours work. Non-farm productivity kind of breaks down durably below trend, 3 to 4 quarters ahead of a recession, alongside private sector hours work. You have private sector hours work; they're slightly below trend, but they're actually moving higher right now. And then obviously non-farm productivity is comfortably above trend and kind of cresting off the high. So if we're heading into recession, in our opinion, it's probably going to be something that looks a little bit more like probably second half of 2025, just based on the current alignment of these indicators. Now, I don't want to mince words. I'll say anything can happen. And so it's our job, it's my job as an analyst and as an investor, is to refresh this model in a Bayesian manner on a daily basis to identify, okay, these things are actually starting to look like there's a recession developing in the economy. But by and large, when you look at these indicators, specifically the persistent leading indicators of the business cycle, like things like non-farm productivity, product sector hours worked, corporate profits, the profits themselves, the broad profit cycle, liquidity, and things of that nature. Growth is also one of those things. None of those things are suggesting that a recession is a high probability outcome over the medium term.
Okay, boy, it's super compelling data.
Thank you.
So, Darius, first off, just another ask, which is if you see that this data starts trending downwards in an accelerating rate that's different from the current trajectory here, please reach out to me. And I'm glad you went to the employment chart, because I was going to ask, like right here, when you look in the, go back for a second to the chart. On. Yeah. If you look here, one of the Z-score lines that is trending in a concerning direction is the employment one here on the right-hand chart, right? Mm-hmm. And do me a favor, and you've just gone through a bunch of specifics. I'm gonna bring it up to just a very high level. Go back to the chart that you were just showing that had the unemployment rate on it.
The unemployment rate?
Not here. No, it was a few charts before. It wasn't one of these.
Yeah, this one here?
That one. Yeah. So you see where the unemployment rate is right now, right at 4.3.
Mm-hmm.
So it's trended down since COVID, since all the craziness there. It bottomed, and then the employment rate has been rising, and the rise is happening at an accelerating rate now. Mm-hmm. When you look at every other recession that we've gone into, it was preceded by this exact same pattern. Right. Mm-hmm. So I guess my question is when you look at all the data that's out there, I know your data is telling you, hey, it's not ringing a warning bell about heading into recession right now. But if you look at this pattern we've seen at every other recession beforehand, we have entered recession, and the unemployment rate has really picked up steam and just spiked like crazy. So what would keep it kind of plateaued here for the next year or so versus following the pattern of history here?
Yeah, more of the same of what's actually happening in the economy. That's a phenomenal question, by the way, because I typically, when you're forecasting economic statistics, you always want to go with the highest probability outcome, obviously. Right. One of those things. And so what you're describing is essentially, in so many words, is the Solomon rule being activated. And that, in my opinion, is one of the things that got investors so concerned about U.S. recession risk, start dating back to last Friday's job report, which is the violation of the Solomon rule to the upside on Friday. And so that is a back test, going back to, I think, as far back as we have data, the Solomon rule has been a perfect indicator of a recession. Now, we would take offense to that. So that's the base rate. So when you're forecasting, you always want to identify what the base rate is, and then use statistics and use variables or features in the model to move you away from the base rate. And sometimes they don't move you away from the base rate, i.e., this is signaling recession. The features in our model are suggesting that the economy is not progressing along a recessionary path. And when you actually look at the data within the labor market, it suggests that we should not be overly concerned about the current rise in the unemployment rate. So I'll start by saying that aggregate income growth is actually still fairly robust. And when you look at this through the lens of private sector employment, private sector wages, and private sector hours work, and productize those three things, we're still tracking at a trend, slightly above trend level of private sector labor income on a 3-month annualized rate of change basis. That number is plus 4.7%. And then we're still tracking at a trend level on a year-over-year basis. And most specifically, we're not seeing negative employment growth. And I know that folks have taken a lot of offense to the payroll statistics, as have we. And so in terms of how we track private sector employment growth, we just look at the mean of the household and establishment surveys, understanding that the establishment survey is probably overly biased to the birth-death model, whereas the household survey is not a very good survey in terms of tracking total employment. And so we merge those things together to get a decent look. And as you can see, we've been in pretty paltry levels of employment growth, really since dating back to Q4 of last year in terms of this metric, but we have not had negative employment growth. And so that's step one. Step two is, and there's 3 steps in terms of answering your question, Adam. Step 2 is we are seeing an increase in labor supply. So if you go back and you look at the growth rate of the civilian labor force in July, in the report where we got the Sovereign rule violated, we had a plus 420,000 body increase in the total civilian labor force. And so we postulate that the reason that the unemployment rate has risen so much is that we are not absorbing new migrant labor into the employed base of America as quickly as we were, going back to last year. And so that's kind of step number 2. And we can kind of see this when you think about the labor market through the lens of this sort of labor hoarding phenomenon. And so what we're seeing is a labor market that is creating slack via non-traditional means, and those non-traditional means are effectively preserving total employment. So this chart shows JOLTS total job openings divided by total employed workers. That number has slowed dramatically in recent years and is now back to kind of a trend type level. We've seen the private sector, so that's indication of slack being created in the labor market. Another indication of slack being created in the labor market is the private sector hires rate. That number is now below trend at 3.7%. We've seen a significant degree of slack created in the labor market through the lens of the private sector quits rate, which is now slowed to a below trend level of 3.3%. So we have indications of slack being created in the labor market, but we don't have indications of actual deterioration of the labor market, and which is very unusual relative to history. And so in these bottom 2 panels, the first one, we show the private sector layoffs and discharges rate, which actually just hit an all-time low of plus 1%, or just of 1%. And historically speaking, the private sector layoffs and discharges rate, which is, us, the firms firing people, actually pushing people into the unemployment pile, as opposed to new migrant labor just winding up in it because they haven't got a job yet. And we have not seen a big deterioration in actual firings yet, which is anomalous relative to how these time series have historically behaved. Historically speaking, the private sector layoffs and discharges rate has been inversely correlated to each of the previous 3 metrics. Another indication of labor hoarding, this labor hoarding phenomenon that we've talked about, I think I want to say we talked about this in the last time we met, which is the divergence that we continue to see between the household survey total employment relative to JOLTS total job openings. Since the early part of 2022, we've had this persistent divergence in JOLTS total job openings and household survey total employment, meaning we've grinded higher in household survey total employment, but we've actually slowed in terms of total job openings. And historically speaking, that's never happened before. That we've always had a positive correlation with these 2 time series. And so kind of summarizing this, we are observing evidence of a softening in the labor market. That's undeniable. We have plenty of indicators that sort of contribute to that as well. Specifically, things like jobless claims, the University of Michigan Employment Survey, the Conference Board Labor Survey differential, those types of indicators, continuing jobless claims. These are all things that are saying the labor market is actually starting to loosen, and perhaps loosen at a faster rate. But we are not observing actual deterioration in the labor market through the lens of this labor hoarding phenomenon. Now, when will labor hoarding, stop? We don't know. This is the first time in the history of the time series that we've observed evidence of labor hoarding in the U.S. economy. We've never seen such slack being created in the labor market and actually having it not spill over into outright firings or a decline in total employment. So we're in uncharted territory from that perspective. And so the fact that we are in uncharted territory from our Bayesian analysis of the labor market tells us that we need to be more respectful about not just overly taking, I wouldn't say simplistic, obviously Claudia Sahn's done Nobel Prize winning work in terms of identifying the Sohm rule, but I think it's important to not take something that has behaved one way across a lot of business cycles and not accept the fact and not do the Bayesian overlay to understand how this current business cycle is actually progressing. And so one thing I'll say on final thing I'll say on this labor hoarding phenomenon, we don't know when it's going to stop. It's hard to know when it's going to stop. It's our job to, nowcast this in real time and try to spot the critical inflection in real time and signal that to our clients. But one of the reasons we have a reasonable degree of confidence that it may persist, at least over the medium term, is that we continue to be in the corporate profit cycle upturn. And so in this chart we show in the blue line, the NIFR corporate profits year over year, and then our corporate profitability model, which is the nominal GDP growth minus the spread between unit labor costs and non-farm productivity, and that's a proxy for corporate margins. And both of those, most of those indicators are accelerating right now, and accelerating past a trend type level. And so, in our opinion, it's very unlikely that we see an unraveling of labor hoarding, this labor hoarding phenomenon, i.e., a big spike in the layoffs and discharges rate to catch up to the kind of slack that's been created in the hires rate, the quits rate, and the jolts to total unemployed ratio, until we see a significant deterioration in the corporate profit cycle. So again, these things will happen at some point over the medium to long term, and it's our job to refresh the same charts and spot those things in real time, but they aren't happening now, which is why we're not as concerned about the violation of the SOM rule. We just see it as more migrant labor hopping into the labor force, but not gaining jobs as quickly as we're creating them. We had been creating them. So the total supply of unemployed people is rising, but they're not rising in a way that is historically consistent with the recession.
Okay. God, I got so many more questions about this, but we're going to have to start wrapping it up here. Your work is similar to the work of Michael Kantrowitz from Piper Sandler. Don't know if you have familiar.
Oh no, I got the idea to stack the business cycles on top of each other from him.
Okay, great.
He does great work.
Yeah. And so his HOPE framework, it's the acronym, and the P is profits, and the E is employment, and the profit domino basically has to fall before the employment domino does, which is exactly what you're saying.
And I assume Michael would probably be in agreement with our conclusions here.
I assume you probably would too. I haven't. I think I interviewed him about a month ago. But what's so interesting is the day we're recording this morning. The morning of this day, I released an interview on my channel with Danielle DiMartino Booth, who is really closely tracking sort of the hiring and layoff, developments on basically a day-to-day basis. I'll put it this way: I think she's a bit more pessimistic than you in terms of what's going to happen with employment in terms of timing. But look, this is what makes a market. And I totally understand your reasons, which is why I really appreciate you walking us through so much data there. So, because even I myself tend to look at a lot of the same data Danielle does and fear what might happen. And your data is a good reality check on that to say, hey, look, some of these shoes have to drop before the employment situation gets really bad. And like it or not, putting judgment aside, we're just going to look at the data and what the data is telling us. And it's telling us right now, these shoes are not necessarily in the process of dropping. Right. All right. Look, Darius, I always wish we could do this for like 3 hours, because I think I would still have 3 additional hours on top of that of questions I'd like to ask you. I'm about to wrap it up, but is there anything that we haven't talked about? I know you had mentioned at some point that you had some interesting charts around bonds. We don't have to go there, but is there anything important that's on your radar right now that you think we should at least flag for the audience before we start wrapping things up?
Yeah, no, taking off my investor hat and putting on my U.S. public servant hat on, I do want to talk about some of the additions and improvements we added to our investing doing a fourth turning regime analysis on this program, because I think it's important, not just in terms of helping clients get to safety in terms of retiring on time and comfortably, and keeping our buy side clients in their seats, and gainfully employed and earning fat bonuses. That stuff's great. That's why we get up and do our job. But I do believe that the Lord has blessed me with a platform to educate thousands, if not millions, of people someday, and to help them understand that there is a crisis coming, and we need to be as prepared for that crisis as we possibly can be, so that we're making the appropriate decisions when it comes time to make those decisions. And so I'll be damned if I didn't use your platform, Adam, to help educate folks on that stuff. So if you
use away, my friend.
Yeah, if you don't mind, there's a few charts that I'd like to share to kind of hammer some of these salient points home before we wrap up. So obviously the election's a very important topic right now. Everyone's talking about the election. We're talking about Trump. First was Trump Biden, now it's Trump Harris. In our opinion, it's kind of a sideshow. Who wins the election is sort of a sideshow in the context of the longer term risks that we're observing that are likely to hit the tape before this decade is over. I think when people talk about the risk of a U.S. fiscal crisis, it's always out in the future, 2050. It used to be 2030, now it's 2050, and all this other stuff. And I'm telling you right now, if you hear nothing else from me, I think the risk of a U.S. fiscal crisis is much sooner than the average investor realizes. And I'll walk you through that information in terms of how we determine that. So starting with this chart here, where we show the sort of kind of quintessential labor versus capital chart, where the blue line shows employee compensation divided by gross value added for corporate businesses. So that's kind of the proxy of labor share of national income, if you will. The red line shows capital share of national income through the lens of corporate profits divided by GDP. And as you can see, starting around the year 2000, there was a functional sea change in these two relationships. Labor, which had taken the lion's share of income in the economy, had kind of broken down to a substantially below trend state and has remained at the substantially below trend state. I would argue China joining the WTO, the proliferation of globalization was certainly a contributing factor to that. But we also had a lot of domestic policy that contributed to that as well in terms of deregulation, et cetera. So this is where we are, in our opinion, and this is why Donald Trump is populist. This is why Joe Biden is populist. This is why Kamala Harris is populist, and this is why whoever becomes president after them will be populist, because they're not creating these policies. They're just responding to a pissed off U.S. workforce that realizes that the people who are winning, the corporate fat cats controlling all the corporate profits and the equity ownership in the country, and that's obviously become a very inequitable situation. So populism is the highest probability outcome.
It's the rich elite's world, and the rest of us just live in it. That's
100%. And so how we get to this populism state, and there's a punchline here, and the key takeaway, just kind of giving away, spilling the milk. The key takeaway is both parties are contributing to a high probability fiscal crisis by the end of this decade. And I don't mince words about that. I say that with all sincerity, as sincere as I'm saying we are in a Goldilocks with deflation hybrid market regime. I'm saying that I do think there's a high probability we experience a fiscal crisis here in this decade. And I don't think the average investor realizes how soon it's going to come. So when we say how we get there, is from populism on both sides of the aisle. Democrats practice socialism for the poor. They inflate the incomes of the folks on the bottom median of the income distribution, and Republicans practice socialism for the rich, meaning their policies tend to inflate the incomes of the people in the upper half of the income and wealth distribution. But guess what? Socialism on both sides, whether you're socializing the incomes of the rich or you socialize the incomes of the poor, requires socialism, and both parties have loved piling on debt to socialize those incomes. So in terms of how the Democrats practice socialism, this chart on the right just shows the kind of persistent uptrend in government social benefits, the ratio of that to household income. It's now 18% off of a low of only 6% going back to 1960. The chart on the bottom just shows the effective corporate tax rate, peaked out at 43% in the early 70s and is now down at only 12% here, kind of scraping off all-time lows. And so obviously we've had multiple policies, a litany of policies that have contributed to these long-term persistent trends. And in our opinion, these two things right here are why we continue to see the budget deficit go up. The Democrats overspend and the Republicans undertax, and you wind up with the same outcome, which is more deficits, more debt, and an faster acceleration towards this kind of inevitable crescendo that we're kind of trying to warn the world about, not just investors, but the broader world. In the post-war era, Republicans and Democrats are essentially the same when it comes to burdening the country with debt. And I think this is a very hot take that some folks are probably going to get a little uncomfortable at these next two slides. But guess what? I want you to be uncomfortable. I want you to have an emotional reaction to this data, because this data are going to help us, you, me, all of us, make better decisions when it comes time to, in terms of being faced with a potential fiscal crisis. So what this table shows is the cumulative growth of U.S. Public debt during presidential administrations. This table on the right shows the cumulative monetization of that public debt according to U.S. presidential administrations. And we do it on a cumulative basis, starting in year 1 to year 2, and then eventually all the way through year 4. And so when you kind of look at this on a overall sample basis, it's very clear to see that Democrats tend to add more debt over the course of their presidencies than Republican presidents. And that's partially because when you go back to World War I, Woodrow Wilson was a Democrat. World War II, Franklin Delano Roosevelt was a Democrat. And so those are obviously two big examples in which the public debt grew, significantly, 8 times in Woodrow Wilson's term, and then 4 times or 5 times in Franklin Delano Roosevelt's term. But when you go and separate this from a post-war standpoint, you kind of draw a line after after World War II, you see that Democrats and Republicans are essentially identical in terms of the amount of debt that is accumulated under their regimes. And so you look at the median after 1 year, Democrats have grown debt by 6% on a median basis versus 5% for the Republicans. after 2 years of their presidencies, Democrat presidents have presided over 10% growth in the public debt relative to 12% for Republican presidents. After 3 years of their presidencies, Democrat presidents have presided over a median 22% growth in the public debt versus 21% for Republican presidents. So essentially identical through 3 years of the presidencies. And finally, in the fourth year, we actually see Republican presidents overtake Democrat presidents in terms of 39%, a median 39% cumulative growth in the public debt relative to a median 26% cumulative growth in the public debt for Democrat presidents. You can kind of see this on this chart here a little bit better. So this is all the same data: cumulative growth of public debt during presidential administrations, cumulative growth of monetization of public debt during presidential administrations. And what we find is that you sort of look at, okay, who's all the guys at the top of the leaderboard? It's like guys like Ronald Reagan, who grew debt by 79% throughout the course of his throughout the course of his first term. George H.W. Bush grew debt by 56%. Barack's first term, he grew debt by 54%. Jimmy Carter's term, he grew debt by 42%. Gerald Ford, in only 3 years, he grew debt by 39%. And then you got George Bush's second term, the junior, at 41%. Donald Trump's first term, at 39%. And then George W. Bush's first term at plus 32%. So as you can see, the key takeaway is there is a odd discussion in this country around which party is most responsible for the fiscal profligacy and the sort of dark path that we're on in terms of burdening our children and grandchildren with massive reams of public debt. And the reality is, I think that discussion needs a little bit more data added to it so that we can use more facts or confront it with some of these policies in the future. And the reason we need to bring this up is because the Treasury bond market is likely underpricing structural tailwinds for both supply and inflation. And so if you look at term premium in the bond market, we're still slightly negative on the 10-year. Historically speaking, term premium on the 10-year have averaged about 149 basis points. That means there's about 150 basis points of risk in the 10-year with no change to growth and inflation outlooks, no change to what the Fed is likely projected policy path is. So that, in our opinion, is a big risk from the perspective of the potential upside surprise that we're likely to see in public debts and deficits over the long term. Because again, Republicans like socialism for the rich, Democrats like socialism for the poor, and both of them love piling on debt to finance their policies. And so that's kind of the one thing we'll say, and we'll end on this, is investors, if we don't have the monetary debasement that we are expecting here at 42 macro and the financial repression that we're likely to continue to see, we're talking about Basel IV going to be implemented next year. That's code word for financial repression. The reason we are likely to see all that stuff is the private sector is now far and away the most dominant sector in terms of the owners of marketable treasury securities. We were at about 36% at the end of 2021. We are now at 54% currently and rising. The Fed's losing share at only 16%. Commercial banks are losing share at only 15%. And foreign central banks have lost share at only 14%, having peaked out at 2008. So we are on a very scary path in terms of the ignorance that I hear out there in terms of who's responsible for that and what. And we're also on a very scary path relative to the starting point of negative term premia and also the current dynamic of the private sector having to finance more and more of the debt issuance here in this country. And the reason this is all really negative, and I'll finally land the plane, this is probably the most important chart that I've ever created in the context of trying to save America. This chart is one of the many charts that we feature in our investing during a fourth turning regime analysis. And what the analysis is designed to do is help investors understand how the various cycles within the economy, both economic and financial, operate during a fourth turning, so that we can create a very clear and concise roadmap on what investors should be doing with their portfolios and how they should be thinking about their broad, risks that they're taking in their personal lives to kind of navigate that safely. And what you find is with data going back to 1800, we see that the budget deficit always widens very sharply in a fourth turning. Obviously, the sovereign fiscal balance to GDP ratio is significantly worse during fourth turnings relative to the baseline of first, second, and third turnings. And so if we know that there is a historical pattern in these fourth turnings, Adam, of weaponizing the public sector balance sheet to fend off, to address whatever big crisis that the fourth turning is. Obviously, we had the Great Depression and World War II. Prior to that, we had the Civil War. Prior to that, the American Revolutionary War. Prior to that, there was a War of Roses, et cetera, et cetera. It goes on back and back and back. And so the key takeaway is, Adam, is we haven't even gotten to the crisis yet. We are on a fiscally profligate path before we even have to deal with the fourth turning. And so my key takeaway is, then I'll put my pen down and shut up. We got to get off this path of here's another $2 trillion in tax cuts. We got to get off this path of here's another $2 trillion in public spending, whether it be infrastructure spending or some sort of form of subsidy to the people on the lower side of the income spectrum. Both Democrats and Republicans are pushing us on a very unsustainable path that might push us off the cliff before the fourth turning even gets here. And that's the number one thing I'm concerned about. And that's the thing that keeps me up most at night, is the kind of ignorance that I continue to hear on Fox News and on MSNBC about who's responsible for what. And the reality is both parties are responsible for putting us in this really, really scary situation.
So there's that past 8 minutes or whatever, or perhaps maybe some of my favorite 8 minutes I've ever recorded in an interview.
Thank you,
You're
man.
talking about what I think is the really big game that's going on here that people need to be aware of. A huge part of the mission for why I created this channel, and I'm sure a huge part of why you created 42 Macro. I think the only thing I can say, because there's so much I can say in response to it, is I would love to have you back on the channel at some point in time where this is all we talk about. We put aside what's the market going to do in the next couple months or whatever, and we just really dive into this, give you a chance. 8 minutes is not fair for you to be able to adequately portray all the issues that we need to take into consideration.
I dare say it's more than fair. That's about all that I need to say. Everything else is obviously for our clients. I don't want to give away too much, but I did want to make that public service announcement, Adam, because I think you share my passion for wanting to help people, not just in the context of what our portfolios are going to do, because that's obviously important, but it's not the only thing that matters. As someone who just, brought a child into the world, I'm seeing that we're on this unsustainable path from the perspective of our fiscal situation before we actually need to weaponize the public sector balance sheet to deal with some larger crisis. We might have a crisis before the fourth turning crisis actually begins. And that's what's scary.
Right. No, what I sort of hear what you're saying is like, look, there's a meteor coming. We all got to prepare for the meteor slamming into the planet. But on the way to before the meteor hits, we may get run over by a bus.
Bingo.
Beforehand. And again, a bus accident of our own creation. So anyways, we can talk about this off air, but I would love for you to come on and for us to talk more about this and actually do it in a live setting so people can ask their questions. Because I'm sure there's a lot of questions folks have that I'm not going to pull up, but that would be hot areas of interest. But one of the key things that your chart said that I will just underscore is this is not the first time in history, where a economic regime has increasingly resorted to excessive borrowing, right, and massive deficits. And the casualty of all that always is the purchasing power of the currency. And one of your last slides was showing that. So one of the things I just want to make sure that people are eyes wide open about is, unless we change our behavior, which between you and me, Darius, I do not think we are going to until it is forced upon us. Sadly, I do not think we're going to get the type of leaders in there who are going to understand this, are going to have the political courage to explain it, and then an electorate that are willing to put those people in office proactively, because the behavior change is going to require a lot of sacrifice. It's not going to be, hey, there's more fun stuff I can give everybody for free. It's, hey, there's a lot of stuff we're doing we're not going to be able to do, right? Because we have to start living within our means, maybe even under them, to try to get out from under what we've created for ourselves. So anyways, my point is we should expect, my opinion, you don't have to share it, but we should expect the beatings to continue, right? Your chart showed, the bottom 90% of the country, their frustration is going to continue to simmer because the rich bastards are going to keep doing well under the status quo for some period of time. But all of our purchasing power of our currency is going to continue to decrease from here. Now, the rich will be okay as long as asset prices inflate at a rate equal to or higher than the currency debasement. But the bottom 90% that don't own that many financial assets, to them, it's just sort of a permanent decline, right? So again, for all these reasons, I think the light you're shining on here is so important. And again, whenever you want to, I would love to dive more deeply into this with you.
Will do, absolutely. When we start seeing emergent properties of the actual crisis starting to occur, I think that'll be a good time to kind of pull back the curtain. But for those who obviously want to get the whole presentation, obviously you're welcome to join us at 42 Macro. I'd love to have you in our community.
Great. Well, so now we're at that time where we got to wrap it up. So for folks that have, once again, really enjoyed the intellect, the data, the structure, the frameworks, the way you think and how to implement it, if they want to follow you in your work and benefit from it, where should they go?
Oh, I appreciate that, Adam. Like I said, I never come on your program to advertise. I come on your program to educate. They often wind up being advertisements, so we appreciate that. But obviously, come check us out at 42 Macro. Like I said, what we do, we have very simple, clear, actionable signals for retail investors. We have a little bit more sophisticated signals that are clear and actionable for more sophisticated investors and obviously professional investors. We have a lot of institutional investor clients all over the world, thousands of retail investor clients all over the world that are all getting access this kind of information on a daily, weekly, and monthly basis. And the most important thing that I would say that one of the more important benefits of our system and service is we created this community of thoughtful investors worldwide inside of our dashboard, inside of our client dashboard. And I'll tell you, Adam, this is one of the coolest things that I've ever been a part of in my entire life, which is putting thousands of investors together. Some, many of them are buy-siders. A lot of them are novice retail investors, and they're all in this community asking questions together. No preferential treatment, nothing, just asking questions and learning and educating each other in themselves together. I'm obviously in there interacting with them and answering questions as well. And that to me has been one of the most things that I'm proud of in my life, because we can really see the impact that we're having amongst our client base in terms of one, helping them get up to speed and across the sophistication spectrum, but obviously, finding and achieving the results that they want in their portfolio.
That's absolutely fantastic. And that is a hugely valuable resource. One that I've sort of entertained with times of how do I create something similar like that here at Thoughtful Money? But if you've already got the community there, especially if it's got, a great mix, but a lot of, high intellect, high experience buy-side folks, you should go check out 42 Macro. So Darius, when I edit this, I will put up the links to 42 Macro on the screen so folks know exactly where to go. Folks, I'll have a link to it down in the description below this video too, so you can get there with one click. Darius, like I said, my friend, you do a great job of packing like 3 interviews worth of data into one, but I sure wish we had 3 times the time to continue going through this, but we'll just have to do it again in the future. Thank you so much, brother. And look, again, congratulations on all the success, but especially on the most important one of being a new dad.
Thank you so much, Adam. I appreciate you, brother. I've learned a lot from you. You're a phenomenal role model for any new dad in the world. So keep doing what you're doing, man. Love it. And all the best to you guys as well.
You're a kind man. All right. Thanks, buddy. All right. Well, now's the time on the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. John and Mike, I'm joined as usual by John Lodra and Mike Preston. John and Mike, thanks so much for joining us. John, I know you're on the road. I'll let you start here. I'd love to hear any of the, your key takeaways from the discussion there with Darius. And I'm sure you're like me, your brain just filled with so much data that he goes through. What'd you think?
Yeah. Hey, Adam. Great to be back with you. Really enjoy Darius. He does certainly cram quite a bit of stuff in there. And Mike and I are engineers by academic training. And yeah, I'd be lying if I didn't say it wouldn't be fun to get in a room with him for a week and just dig in and try to bust some models and validate others. But so appreciate his the fact that he has a system, right, and has data, because there's so much in our industry that is mantra driven, slogan driven, and ultimately the data matters. And our system, our process is very much data driven. I will say, being an engineer, and Mike, I think will relate to this for sure, because we talk about it all the time. We want everything to be precisely model driven, and it's just not that simple, because markets at the end of the day are emotional, they're psychological, and there's a tendency that we can overfit things, right? And in fact, some of those brilliant models in the history of finance have turned out to be at times not as reliable as one might think. So for example, the long-term capital management debacle in 1998. I mean, this was the brightest set of guys in the room, guys and gals perhaps, but I think it was mostly guys. And they had a quantitative model that was to take over the world, right? And the point being, and Darius, I think, does a nice job reflecting this, especially in his culminating comments there about the fourth turning and the backdrop of societal unrest, and how ultimately that can really drive markets more than anything. It's really important to take a step back and not let a model be rigid. There's got to be room for shakeouts, and our system that we've devised over the years made a lot of mistakes. We've learned and continue to learn every day. But it's important to have the data, be driven by the data, be tactical, we think, especially in the phase of markets that we're in. And that's one of the things we like about Darius. He is tactical. He speaks to letting the data drive. And we'll be short on charts and stuff like today, because I think Darius gave us a week's worth of charts. But those are my main takeaways. I just want to kind of call out and give Darius some good kudos on.
Okay, and Mike, I know that I'll give you a chance in just a second to piggyback anything else you want to say about Darius's presentation. I know that there's some interesting things happening in the market right now over the past week, and I do, John, want to make sure we get back to those before we wrap up here, even though we're going to keep this segment here a little shorter than normal. But yeah, Mike, anything else you want to add on to about Darius's interview?
I really like the fact that he had a system, Adam. He talked about trying to identify what regime we're in. I think that makes a lot of sense. I think that we look at it similarly, but a little bit differently. And I think that not every time is the same in history. We are at I think a crisis/climax point. Darius talked about fourth turning, and I think that we are entering that point in the next few years. And I think that most of us on this program, I know that John and I at least agree on this and how this ends. This ends very badly. Valuations are not sustainable with positive real returns, and not positive nominal returns for that matter, from this point going forward over the next 10 or 15 years. So this market ends up trading a lot lower than we are today. We're absolutely certain of that, according to the math. We can't say that it will definitely happen, but we're certain that it should happen. Let me put it that way, based on the math. The market should be 50 to 70% below where we are right now, whether or not we have a blow off top. And there are signs that we are building up momentum for one final gasp. We'll see. Talk a little bit about what happened in the last week or two. We've had a pretty sharp pullback. A lot of pessimism has come into the market very quickly. Things like the AAII bull-bear spread has gone from 30% to zero, roughly, in just a couple weeks' time. That's a pretty quick move towards pessimism. Now it often gets to be minus 20 or minus 30% before major bear bottoms. But one thing we're noticing here, both in conversations we're having and in the data, like I just mentioned, and even the sheer fact that a lot of the brokerage firms are getting swamped with orders on even the smallest of pullbacks, tell us that pessimism is alive and well and comes in very quickly. We're not willing to place bets based on this, but that is one of the many signs that say we could have a short-term bounce in the market. Another one is the VIX spiking to 65 and pulling back to the low 20s here. I think that was the single biggest one-day jump in VIX since COVID. So I know I'm rambling off from what Darius talked about, but he's got a neat model that tries to identify regimes. I think that's similar to what we do, in that we think we're in a very, very dangerous point. He talked about Goldilocks/deflation, so it's a little bit two-sided there. Some real deflationary battles going on, but he said that the shoes haven't dropped yet in terms of some kind of financial accident and or recession. I think we have to agree with him. The data that came out on Friday, the employment data, was higher than expected. I think it was the numbers looked like the unemployment rate was 4.3 versus 4.1, and new jobs was 114,000 versus 175. And so a lot of people talked about the Somme rule being triggered. He talked about that too. But migration and immigrants kind of skew the data. But honestly, it doesn't really matter. People talk about, is it a recession? It doesn't matter. The stock market's going to tell us. And the stock market's probably going to bottom by the time the recession is actually declared. It was interesting. He talked about Bitcoin. I thought that was kind of neat in his keep it simple model, and that they can go up to 10% Bitcoin and they just bought it back. We prefer to focus on bullion and miners. We tell our clients to have a 5 to 10% position in gold and silver bullion. Can't imagine Bitcoin doing well without gold and silver doing well. However, I must say that the chart of Bitcoin looks pretty bullish. It had that shakeout to 49,000, back to 60. If it breaks through 70, it should sail right to 100. I wouldn't be surprised if that happened at the same time that gold was breaking through 2,500 in a new range of 25 to 3. Gold is sitting right there right now. It's having a good day today, up 30-something dollars. So overall, we've made a few tiny adjustments on Monday in the big plunge on the Nikkei, and in the market, we sold some calls on our Japan ETF to hedge that a little bit. We're already running at around 40% equities, pretty cautious. So we're not adding on that weakness. In fact, a lot of our short-term indicators have flipped to negative, so we're more likely to sell into strength the weakest of our holdings if all of those indicators reverse back up, which they very well might, and we'll see in the next couple of days. If that happens, then we will add some new ideas, but yet still, we're probably going to keep it pretty light in equities at maybe 45% because of the macro backdrop. So I know I've been going on a while. I'll pause, but I'd like to maybe just chat about a couple things that look to be working, like some of the sectors that have strong technical strength, that kind of thing. And mid caps, I'd say keep an eye on mid caps. This is the last thing I'll say. IWM based out at around 200 and popped up to 228, I think, and then immediately gave all that back in just a couple days. That's not a great sign, first off, because the market was broadening and this kind of reneged or took that back. IWM's got to get above 210 or 215 pretty quickly to repair that damage. And I'm looking today, it's at 206, 207. So if we see the mid caps and the equal weighted S&P rebound and repair that damage, then I could, this rally will probably continue.
Okay. All right. Well, look, John, let me come back to you, and then I just think time-wise we'll start having to wrap it up. But one of the big topics for discussion over the past couple of days has been the unwind in the yen carry trade, right, in Japan. We talked an awful lot about it on the live Q&A that we did on this channel on Tuesday morning to help explain for folks what had just happened the day before in terms of the big global market sell-off then. So there's been some recent developments on that side, and I wonder if you can just sort of update folks on what you think the implications are, right? What it seems like, the yen was really appreciating versus the dollar, and I think the Japanese government was sort of allowing that to happen, but the wheels started really looking like they were going to come off the car. Their head of the BOJ came in and said, "Hey, we're actually going to start taking measures here to start easing the yen a little bit." And then I guess the big question has been, well, how much of the carry trade unwind has happened? How much more needs to happen from here? And I've been seeing conflicting predictions on that, but today I'm seeing headlines from JP Morgan that it's 70% more done already, which is basically trying to give people some hope that the light at the end of the tunnel. But what do you guys think?
Yeah, Adam. So that has been a huge backdrop. We had a lot of noise and a lot of talk about the employment numbers last week, but simultaneous to that was this action going on with the yen carry trade. Just a bit of review for viewers that might not be familiar. So the yen has been kind of a cheap currency and has gotten cheaper in recent weeks. I'll just share a chart here just to put it in context. And I know we promised not to share too many charts, but I think this one will help paint a picture. So hopefully you can see this chart okay. I'll hide our faces. But this is a weekly chart. Each one of these bars is a week. And basically we had, when the line is going up here, this is the pair, the US dollar, Japanese yen currency pair. We had a major weakening of the yen. And that's denoted by this rising trend here. And then in a very short period of time, we had the yen strengthen. That was driven by the Japanese Bank of Japan, surprising markets by raising interest rates, short-term interest rates, rather abruptly, because they're worried about some inflationary pressures there. So we had a major, and I'll show a daily chart here just to kind of get granular. This is a major strengthening of the yen, and what that does, and you can see actually there's been a re-weakening here in recent days, and I'll explain why. What that does is so much of the financial system has been built up in this yen carry trade where people have borrowed in yen or shorted the yen, same kind of thing, to go and invest in other high yielding instruments, other more momentum type of trades. And with that sudden strengthening of the yen, many people, and I'm not saying people as in individuals, but institutions were caught off guard. Major unwind of risk positions. And yeah, JP Morgan came out and said they think about 75% of that has been undone or corrected, if you will. I've seen other reports, basically looking at it in the context of what percentage of the Bank of Japan balance sheet is held by, or bond issuance is held by foreign entities. That's another way to look at the potential size. The truth is we don't know exactly, but what we do know is that this system has been built to speculate over the last 15 years by massive monetary policies that have fueled speculation, and we're seeing this is one shot over the bow that is in the phase of unwinding. So much of the action in the markets over the last week certainly have been driven by this unwind. We don't think it's over. And in fact, even if the so-called yen carry trade is largely undone, we think it's just emblematic to a whole bunch of other excesses built in the system, whether you want to talk about private credit, you name it. There's an abundance of surplus and distortion in the system that has yet to work out, and we think there's no doubt it will in due time, and that's what has us concerned about where we are in markets with record valuation still, even with this little pullback from the top. That hasn't done anything to remedy extreme valuations here in the US stock market. I did want to make a quick comment though, Adam, about our hedging. We've talked a lot about hedges that we have for our portfolio, and I'll just share a screen again here and look at the S&P 500. So this is a daily chart of the S&P 500. And you can see that the chart pulled back from, way up here, pulled down to about just under 5,200. This horizontal line is where we have put options on the S&P 500. So the move down here is effectively like a deductible that, our clients had to pay on insurance. Much like when you buy insurance on your house or your car, the insurance doesn't kick in until you have paid your deductible. And there's a trade-off when you buy insurance. If you want a lower deductible, that insurance costs more, and vice versa. We, for a lot of good reasons, set the strike price of our put options at 5,200. That's this prior, kind of swing low here. We actually went into the money on these put options, so the insurance started to kick in really robustly. But make no mistake about it, our client accounts did see some downside action in this abrupt pullback, not as much as the broad market, but there was some downside action. But those puts really kicked in, and right now we're hovering right around the strike price of those options. And we'll want to do something there to kind of extend that insurance here in the near future. But it's really important to take a step back and see, we have, we think tremendous downside still in this market eventually, even if the short term is going to be seeing a bounce. Here's where that strike price is on a monthly option. We could easily come back down to, high 4,000s, or even the 50-month moving average down to low 4,000s. There's tremendous downside potential here, even though we think in the short term here we're likely to see a follow through to the upside.
Okay, great. And just as a reminder for folks, if you want to learn more about the ins and outs of hedging, recorded a video on this channel, about a month ago with you guys, John and Mike, where you guys really walked through kind of the fundamentals of how to do it. And again, good reminder for folks that, with a hedge, there's in most cases a premium that you have to pay. So it's not 100% correction from, or it's not 100% protection of loss from the get-go, but you're just like you buy an insurance policy, it's to be able to take an acceptable degree of loss for gaining a much greater percentage of asset or loss prevention. And of course, part of the science is figuring out what's the right price to pay and how much deductible you want to have and all that type of stuff. And again, that's why I always tell people, leverage the expertise of somebody like you guys who does it an awful lot, rather than trying to figure it out themselves on the fly, especially if they don't have a lot of experience doing it. All right, guys. Like we said, we're going to keep this one a little bit short because Darius went a little bit long, but lots going on in the market. Really look forward to having you guys back on again the channel next week to continue to make sense of where we are and where things are headed. Right now it seems like we are in sort of a nice bounce from the sell-off that's been happening over the past couple of weeks. And I think the question in everybody's mind is it going to continue? Is just a pause that refreshes and then the sell-off continues, or is this a true bottom and we're off to better prices, maybe even all-time highs as we go forward from here? That being said, folks, two things. One, if you enjoyed having Darius on as a guest and would like to see him come back on his channel again soon, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Also, as Darius said, and as John and Mike have been saying, with this regime change, right, from Goldilocks into deflation, from a regime change, it's a move from a risk-on regime to a risk-off regime. Therefore, back to my football analogy with Darius, you're sort of switching from playing offense to defense here, and not that there isn't potential for upside, as Darius and I talked about with some of the more defensive and staple-driven sectors of the economy. It is much more of a defense regime. And so that plus the overvaluation issues that John and Mike have raised very often, highly recommend that most people review their portfolios and say, look, am I playing adequate defense given what's going on right now? If you've got a good financial advisor who understands all the macro issues we've been talking about here and is using that to create a customized, appropriate portfolio strategy for you and then executing it for you, great, stick with them. But if you don't, if you'd like a second opinion from an advisor who does, maybe even John and Mike and their team there at New Harbor Financial, then consider scheduling a free portfolio review consultation with these guys. To do that, just go to thoughtfulmoney.com, fill out the short form there. It only takes a couple seconds. And these reviews, these consultations are totally free. There are no commitment. There's no strings attached. It's just them trying to help as many people as possible, position as prudently as possible for what may be lying ahead. John and Mike, guys, thanks so much. I guess, Mike, I'll let you have the last word. Darius, I think, did a good job of telling people, hey, there are lots of reasons to now be shifting to a more defensive stance here in the short term. But with his last material there on the whole fourth turning, he said, look, at some point, looking out here, there's going to be a big fiscal crisis that folks are going to need to defend against in the long term. As professional financial advisors, you can have discussions with people in terms of trying to help them figure out how to prepare for both those timelines, right? What they can be doing in the here and now, but steps they can be taking in their portfolios, but also maybe just in their lives in general about some of the bigger, longer term risks that Darius flagged, correct?
Yeah, I'd like to say that this is all systems and mathematics, Adam, but a lot of this business, or at least the way that we do it, is a lot of it is involved in your personal life and in psychology as well. Just behaviorally, it's difficult to stay the course, particularly in a time like this. The climax of a fourth turning is going to test us all. And fourth turnings are defined by times of maximum risk, maximum effort, and often are difficult times. Not always, but often are difficult times. The good thing about the fourth turning is that it's followed by a first turning. And for those that make it through that, it's really the best time ever to be alive. Think back to the 1950s, the awakening of the first turning. That was the last first turning. So a wonderful time with great opportunities, but we have to get through the fourth turning first, and we probably have at least another 5 years to get through it. So we're talking all the time with people about how to prepare, how to prepare your portfolio. Obviously, that includes reducing stocks, raising cash, and you've got a great gift with short-term interest rates of 5% right now. But it also includes paying down debt, buying gold and silver, investing in property if you don't already own a home. Sometimes that makes sense, although we have to be careful about the bubble we're living in there as well. So don't overcomplicate it. Keep it simple. And for a lot of people doing it themselves, that might literally mean just sitting in treasury bills for now. We talk to lots of people that are sitting in treasury bills. It's not good for Wall Street because you can't manage the money. We realize that too, is probably even our own business could do better if we encourage people to manage money with us. But for a lot of people that are sitting in treasuries, I think that's the right thing right now, particularly based on if they have very cautious psychology, if they're not sure about their goals in the mid to long term. You really can't go too wrong by doing that for a little while. The real trick is going to be when to stop that. What are you going to do when rates plummet towards zero again on the front end? And they will. And the stock market's crashing. Are you going to jump in when it's down 10%, 20%? What if you jump in when it's down 20% and it drops another 20? Then what? Most people will get fully invested, in my view, long before the ultimate bottom, because this market should fall 2/3 or more. I'm not saying it will, but it should. And it's going to be really difficult to get in on the way down. And that's one of the biggest things I think we can help people with during that time. But we can help them now prepare, and whether they're working with us or not. We can help them get out of risk, build T-bills, get some gold and silver, that type of thing. And we're here for you. So reach out to us and we'd be happy to have a free talk.
All right, well, thanks, Mike. We'll have to leave it there. John and Mike, thanks for joining me for yet another week. Look forward to having you guys on next week to make sense of whatever happens between now and then for everybody. Everybody else, Thanks so much for watching.